one. Boom, there it is, right on time.
Ladies and gents, boys and
Boys
girls,
and girls.
COVID will present to you some great real estate investing opportunities right after this.
Shut up and sit down.
The Business Bros Podcast was created for you. Learn from the business professionals who come to share their stories. Find out what's working in business and social media, what's hot and what's not, straight from the mouths of successful entrepreneurs out there doing the real work. And now, welcome to another episode of
Business. There it is.
Dude,
I love it, dude. That was awesome, by the way. I dropped the fire intro. That was a pretty fire intro. I like it.
that was pretty good, huh? Yeah.
That's pretty good.
I don't know, dude. It just comes to you like that little red light goes on, and then boom, we're at it.
Boom,
dude.
there it is.
Now
Well,
you
here we go. Here we go. Ladies and gentlemen, it is Monday, and man, I love Mondays. I know I'm a freak for that, but it's when we get to doing what we love most, which is talking to people and being of service to others. Our guest today is not from the same cloth. He's passionate about helping others reach their dreams and expect more out of their lives. Our awesome guest has a ton of experience in entrepreneurship and real estate investing, dedicated to empowering that same entrepreneurial spirit. So joining us today as a real estate investor in the country of Texas, welcome to the show, the real Smith.
How are you guys doing today?
I
How you
did.
guys
My bad. My bad. Epic fail on my part. I was so
Epic-
excited. I got
It's a good
hung
one.
up on the epic country of Texas line.
It was the country, it's the
Solid.
country of Texas. I mean, you know,
Jeff, how's it going, man?
truth.
Fantastic. How are you guys?
Dude, I am pumped. It's Monday. We're ready to rock and roll.
Hells yeah.
You
You got a great shirt. I mean,
Yeah, great color shirt.
There you go.
It's a good
I know
day.
it's-
I got to
We're
be
matching.
the literal black sheep, so it's cool.
You're one off. One off.
Jeff, dude, so much going on. Like, it depends on who you talk to with what's going on. I know literally from a buyer's market, buying and selling on the market here in San Diego is hot. I mean, houses inventory goes, we don't have enough inventory, so houses go fast. Hot, right? It goes really quick. Prices seem to be like endlessly going up. Interest rates are low. It's been crazy. However, I tend to read into a lot of other things. I listen to a lot of different real estate professionals in the mortgage space. I listen to professionals in the real estate space, in the coaching space. And there's some things that have come to fruition lately and things that are kind of being forecasted that you don't really see in the mainstream media, which tells me that there's going to be a shift in the market sometime soon. And it's perfect that these types of things are happening, because I get to talk to you about preparing for some real estate investing and what you see in the market. So let me give you a little bit of tidbit as to why I think the market's going to be shifting.
Okay.
I'll start off with, first of all, the forbearance period, right? So when COVID first hit, we hit tremendous amounts of people losing their jobs, right? I mean, huge amounts compared to where we've ever been in any type of economy.
What did it cap out at, like 30 million or something like that?
It was something ridiculous like that.
Crazy.
Things have come back dramatically, but we're still over 10% in unemployment. Now, there's people in certain positions that have been losing their job, even if they got their job back, not necessarily having the same income as they had before, not necessarily having the same guarantees. We're starting to see things where lenders are saying, yeah, you're pre-qualified. And then at the last minute, they're saying, you know what, that 3.5%, we're actually going to need 5%, or we're actually going to need 10%. They're putting in these buffers and these cushions in place because, let's say, for example, you were going to buy a condo in a place that 70% of the people haven't paid their HOA in the last few months. And so now, instead of having that 3.5%, you actually have to kick down 5 or 10%. It's because you got to have reserves for your HOA, like all kinds of little weird things like that are kind of going to start shifting the eligibility for people to buy, shifting the market. And I see it happening in the next like six months or so, beginning next year's first quarter, maybe into second quarter. I just see the forbearance period ending, people shifting from not making their payment because they were okay to now not being able to make their payment, entering into short sales and foreclosures. What do you think? What's your ear to the ground telling you?
Yeah, I mean, I think a lot of the job losses were unfortunately or fortunately, I think that most of the job losses that we experienced were in the hospitality industry so far, whether it's hotels, restaurants, things like that. The market is super hot from what I'm seeing, and prices are holding steady. If you're south of like that affordable housing number, which depending on your area, like is whatever it may be, it's dependent on where you're at geographically in the country. Let's say for Houston, that may be 350,000 and below. And like those houses are not staying on the market at all. From an inventory perspective, I think nationwide, usually 6 months of inventory is like standard, right? You're aware of retail real estate, how that flows. That's a normal marketplace. I think last I checked, we were at 3.5 months right now of inventory. So nationwide, the inventory is short, correct? And
Absolutely.
so I think where people are really where you're going to see what you're talking about is in that middle tier of price point. And in San Diego, it's obviously different, but like if we stick with our Houston numbers of like 350, that next tier, like going from 350 to let's say 750 in houses, I think that's where you're going to see a stalemate in the market, and those houses are just going to sit a little bit longer. And I think you'll see some of what you're talking about with regards to the forbearances coming due and people struggling to restructure those. Although I've talked to a handful of people that have taken those forbearances, and they're actually offering a variety of resolutions to how they're going to do it this time, to the point where they're even putting them on the back of the mortgage, which is helpful for people. But I mean, if you don't have any income, obviously it's not going to help, unfortunately. But I mean, what you're seeing, the other factor that I would say that's playing a role in the space that I play in, which is investors. There's just a lot of money sitting out there. There's a lot of capital. I'm talking to a lot of people that the international money is still coming in, which they want to park it in real estate, obviously, because it's asset backed. And so
I'll throw in a wrench in this. So on the one hand, yes, we have that international money coming in, and
Yep.
here's my kind of common sense feel and approach to the real estate side, right? I remember in 2003, 2004, 2005, 2006, market was super hot. Very similar to what we're seeing right now as far as increasing prices year over year, low inventory, low interest rates, some of those very similar type things. And affordability gets ridiculously crazy. And, at some point, for me, I try to make it as simple as possible when it comes to explaining some of these metrics and when we see a shift in a market. And it has to do with things like affordability. Can I afford to buy this place? Right? If I can't, if the price of the home is going up, means incomes should be going up at a relatively similar rate, right? So that these things can catch up to each other at some point. But incomes are not increasing at the same rate. As a matter of fact, they're actually going backwards because, like you said, a lot of the travel and hospitality businesses are losing. I mean, they're gone. Who knows if a lot of these restaurants are ever going to come back?
50 of them aren't.
According to some statistics, 50% of them aren't.
Right.
So to me, I'm just starting to see a lot of writing on the wall that the growth that we have is not sustainable. And the fact that the mainstream, media is saying how hot it is, how, I warned people in 2008. I was like, look, if the gardener comes up to you and is like, real estate is hot right now, and starts sharing, real estate investing tips with you, there's something going on here. It's a little bit different, right? And I kind of
Well,
see that we're in a very similar situation.
the only difference is that lending hasn't been loosened. So like money's not really easily accessible in the residential marketplace if you're doing a primary residence. I mean, they did a hard stop on lending, as far as I know, for almost everything for about 90 days when this whole thing started. And they're still, the restrictions that are on investor properties right now are still onerous. So the stuff that's being bought is cash deals or private money that's going on. And then otherwise, I mean, if you're using lenders, they want 65, 35 on the deals, which obviously most people can't come up with 35% down payments for investment properties. So while I tend to agree with you, I do agree with certain things that you're saying, which certainly, the fact that wages are not increasing at the same rate of housing prices is 100% accurate. There's no question. That's been happening since before
Forever.
Before 2008. I mean, that goes back to it's a much longer discussion, but I think what you're alluding to is what's the issue that we're going to run up on, which is the lack of true affordable housing that is going to affect more and more people as those prices continue to climb. So I mean, some people speculate.
Yeah, wouldn't that affect the supply and demand curve, right? So if you have less and less buyers qualified to buy, should kind of start to begin to stabilize what we have. The inventory will pop up a little more. You'll have more and more houses sitting on the market a little bit longer. And it's like you said, we're at about 3.5 months of inventory. A 6-month inventory reserve is a normal market. So we're still in a seller's market, but we're going to see a shift to a buyer side. And I wonder if ever we see a shift to a buyer side, if ever we see something like that, is it going to be a quick shift in the downward direction, or are we going to see, extensions of things, like extensions of forbearance? I can't see any politician saying we're going to take away forbearance in the near future. Like that's like political suicide almost.
Yeah. I don't know. I mean, I think the forbearance is going. Well, they're going to have to, the forbearance is going to have to go away. There's no question, or there's going to be giant bank bailouts again, right? I mean, that's what led to 2008. But the difference is in this particular real estate recession, I mean, it's not a real estate recession, but this particular recession is banks are highly capitalized right now. And in 2007, 2008, they were highly leveraged. And so it's just a different financial position for the banks currently. But I mean, if you give 30-40% of your clients aren't paying for 6 months, like it flips it, right? To an extent.
So I mean, who knows what's going to happen down the road. I like to throw out some of these what ifs, because it's always one of those things when you're investing in real estate, you plan for the worst, you hope for the best, plan for the worst, right? And that's kind of the situation that I tend to look at. So let's talk a little bit about getting into different types of investments, because I'll be honest, to do a flip right now, I would be terrified to be caught with my pants down, in any type of shift. But there's people out there doing it. Like literally, I was showing properties today, and as I'm going down this one street, I'm looking at 2 different properties that are being completely gutted and remodeled. Go down the street, there's a couple other construction trucks. Like people are in there getting this type of work done. The fact that inventory is low is like blood in the water. Like, let's get another one, let's turn it around as fast as possible, and let's get our return on investment like quick, ASAP.
Well, I mean, the flipping, that's how the flipping business works, my man. Like they've got to keep flipping or they're dead. I mean, they can't stop, because once you build those big organizations that flip 10 to 50 houses a month, like they're built on volume. and like that's the only way they can operate, or they're not profitable. So they've got to run it red line
Nonstop.
the whole time
Yeah.
until it's done and the party's over. Like that's that's how they're structured, unfortunately, because of the tax structure on their businesses and things like that. Because the profitability that you see on HGTV is not what a true flipper gets for a flip. I mean,
Yeah, they don't tell you that every time you sell that, it's considered like a product at a store. It's almost like you're at a liquor store selling products. You have a cost of goods, subtract out the cost of goods, you have a net profit, and guess what? That's not long-term capital gains. You're paying ordinary income tax on that, and it gets pricey. You're absolutely right.
Exactly. After you do 3 or 4 houses in a year period, you're considered a broker. And so anybody doing more than that is paying earned income tax rates. So in California, they're paying north of 40 for every single flip. So that 100,000 they made on that is not 100,000. And so, I mean, you understand why they're doing it, but again, I mean, it goes back to the price points that are safe in that market. I would say low end affordable housing is your bread and butter if you're flipping. Now they're hard as hell to find, because there's a lot of people like down here. If you're looking in that market and you're finding deals, like almost everything I'm seeing that is buyable is off, like they're off market pocket deals coming to me. The ones that hit the MLS, like they don't stay on the market 5 days. If they're an actual decent deal, not even like holy shit amazing deal, like if they're okay, people will buy them. But flipping is the same way. That the high end flippers, they're playing Russian roulette, I think, because eventually, I mean, that's where the market's gonna contract.
Yeah, you start seeing it on the higher end for sure. What are you guys doing as far as your real estate investing strategies? What are you working on currently?
Well, I only play and buy and hold stuff, and so I do like Burr method, which if you're familiar, I essentially flip it and hold it instead of flip it and sell it. I come in, I buy a property that's distressed, we completely remodel it, upgrade everything, all the mechanicals, everything else, so that there's no repairs for a period of time, 48, 60 months, keeps your CapEx down on your holding costs. So you theoretically, if you've got decent tenants, don't get phone calls in the middle of the night about things being broken if you do the right things. It's also a way to come in and capture equity right off the bat. So I generally try to come in, buy the property right, remodel it with the teams of guys that I've got, then refinance it. Well, I rent it first, then I refinance it. And once it's refinanced and stabilized, then you've got your true cash on cash for that property. And then you've got the equity capture that is unrealized until you exit that deal.
So that's a lot of work for what kind of return are we looking at? Are we looking, because I know when I was looking at major companies like the BlackRocks of the world coming in and buying up long-term rentals like that, they were looking for somewhere between like 7 to 8% return on investment, and that was, I mean, that's not very much, but they're buying a lot at a time. For people like you and me to come in and do that kind of work for an 8% return, it gets kind of tough.
Yeah. People probably won't believe me. I try for 20-20. So I try for 20% equity going in and 20% cash on cash in the first year. So like
that's definitely more doable, right? That's a strategy that you can survive on.
Yeah, and if you're paying attention to it and you're overseeing the projects and like doing it as, and you've got teams of people that can do it. See, BlackRock had never played, like those funds had never come in and bought single family portfolios. They had never come in and bought small apartments or anything like that. They were dealing in A/B apartment complexes. And then you watch the numbers get suppressed so low in apartment complexes, and cap rates go so low that they just couldn't make any money in it. So now, I mean, BlackRock came in. I've seen them buy portfolios of 15,000 to 80,000 houses at once. Just rental properties, single family home rental properties. And what they're doing is they're scaling the model. So if they could go out and buy a class A apartment complex and they're only getting 2% or two caps on multifamily, they can come in and get still 7-8% and infrastructure necessary to maintain 15,000 single family homes, which is cost prohibitive, right? Because every door is located somewhere else in town. Every air conditioner is one air conditioning unit. Like, I mean, there's a reason people say, there's a reason Grant Cardone's like, don't ever buy one door at a time. And
yeah,
because I mean, when the saying goes, you're 100% occupied or you're 0% occupied when you're in single family homes. So
there's no
you go to zero as soon as you're, exactly. And so the reason that I started with single family homes and still hold single family homes and still kind of play in that space is because of the long-term appreciation, because they appreciate like crazy. But the small apartment complexes, or if you buy ones, twos, threes, not ones, but twos, threes, fours, you can do 4 and below in your personal name at the bank, and you can still get your like same benefits of a primary residence, like, and get the crazy low rates of 2.5% or whatever they're doing right now. You can buy a quad and do that right now still, because everything 4 and below is considered a single family home. Now, when you get into 5 and north of 5, it's commercial lending. And so you're paying 2 points more, essentially not 2 points, but 2 percentage points more. So those are closer to 4.5%, 5% instead of like your threes you can get in your really advantageous interest rates. But the appreciation on the single family homes is where you can really build a lot of wealth as well if you've got a handful of them stacked, because the national average for appreciation is 6% a year. So
and
if you just,
that plays out to an overall a bigger strategy. You're playing Monopoly essentially, right? So you're buying up 1, 2, 3, 4 unit properties. Now last I checked, Fannie Mae still lets you do like 10 loans under your own personal name. But the cool thing about that is once you build that portfolio of such, once you hit that appreciation rate, you can 1031 them, turn them around and not pay any of that capital gains tax and move up into, buying 50 doors or 100 doors in an apartment complex, at which point that equity goes to work for you. Which is definitely a great strategy to have. It is more of a long-term strategy, but it's something that anybody can get into it one property at a time. Yeah.
And it really is whatever you want to do as far as like your risk aversion and your tolerance as well, because you can have 10 and my wife can have 10. Like, one of us has to hold our primary residence, and that counts as one of them. But I mean, we could have 19 between the two of us. And if that's 19 quads, that's a boatload of doors right there.
Math teacher.
Math teacher.
So do the math teacher.
Right? It's like 76? 76 doors? Yep.
Yeah. and your primary residence. So you'd have 77 if you...
And that's a lot to manage, though, right? Like I've heard a bunch of different strategies on management. Some of them are, self-managed strategies using things like home warranties and being able to utilize those types of, pay the deductible and get the things done, or use property management companies. What do you tend to do as far as maintenance wise? Because holding a ton of doors, I mean, I don't think you're at 77 doors or anything, but the potential is there. But even for us managing 5 properties, for example, that gets like you start going a little stir crazy when you start. What, this is going to cost what? I thought I just paid that one on this one. No, that was the other one.
Yeah,
like it gets a little nuts.
No, we've got 38 right now, and we self-manage about 6 of them. And they're pretty much it's definitely single family homes that we've had tenants in for a long time, that we've owned for, I mean, we've done all that in 2 years. I hopped back into real estate 2 years ago. And so the 5 or 6 that we're managing personally right now are just people that have lived with us for the whole 2 years, been low maintenance. I'm looking to still turn everything into management once we turn those properties into new tenants.
That's go ahead, James.
Gonna say those 38 properties, where are they? How close to where you live are those properties?
27 of them are 3.5 hours away from my house, and 11 of them are within a 40-mile radius of where we live.
Definitely, it's either way.
Say that again.
So it's definitely driving distance either way.
Yeah, but
yeah,
we tend to not manage, like we tend to not self-manage. I've got a team of people that do almost everything. I mean, I've got everybody in my phone that takes care of everything, from mowing the grass to handyman stuff to plumbing, electrical, HVAC, all of it. Now, the number one tip I would say is, if you're going to self-manage, like, find that handyman as soon as you can, because that's who you always want to send out first, because he's got the lowest call cost. And because if you send out HVAC, you send out plumbing, stuff like that, those guys are $85, $100 an hour, $100 to get the service call out there. And if you don't want to go check it first to see what's going on, to see if it's just a little, like, I just tightened up that hose on the back of your toilet and we're done.
You're good.
Yeah. You much rather, it's way more palatable to send your handyman over there for $25 to $45 for a service call and let him do that and save you an hour-long drive round trip or whatever, than sending out the actual plumber.
For sure.
Who's
a part of your
off
strategy?
Send him anyway.
That's true. Was it part of your strategy to get close?
No. I'm not opposed to owning properties that we're not near at all. But
have you ever looked in?
I'm sorry. Go ahead.
Oh, no. Please finish.
When we would buy, if we were going to buy properties in different areas of the country, I would go in and make sure they were stabilized, and I would stay there, not stay at the house, but I would stay in the area for the first however long it took, a couple weeks, to get a team built, get management in place, and interview different management companies, because management companies are all over the place with regards to what they do, their fees they charge, who's used them in the past. I would ask for references, because some of them nickel and dime you to death, and like their fee will be $50 a month, and you're like, whoa, that sounds fantastic for $50 a month. And then you get your line item receipt, and you're ending up paying $425 a month for one single door, because they put in new ceiling fans every 3 weeks or whatever they do, right? So, and I'm not saying that they're nefarious by any means, but you do need to vet them like they're a member of your true team.
They are.
Yeah, 100%.
Absolutely. Yeah. I mean, when it comes right down to it, we're a real estate investor, whether it's your handyman, your plumber, your whoever you've got work for you, your property management company, that absolutely is a part of your team. You are building a network. You are building a team with every one of those that you.
Agreed. Yeah, exactly.
So what, Jeff? I mean, I know we talked about this last time, but what are we going to find at therealjeffsmith.com?
It's just a website that I built for my actual mentoring company. I've done business consulting for 3.5 years and been mentoring businesses in different industries. I own a gym, which is what we talked about last time. I own a gym here in Houston as well. I started that from scratch 9 years ago, and then we moved back into real estate about 2 years ago, and we've got a couple companies with regards to real estate. My wife's a realtor as well. She's on the retail side. She doesn't do a lot of retail stuff. She mostly does our deals and then investor deals as well. So the idea of the website is go out to therealjeffsmith.com, submit your email address. We'll start a conversation. If you want to get on our list, we can send you deals. We'll vet your deals for if you're interested in certain types of properties. We'll shoot them your way, whatever you're interested in, basically. I also do real estate mentoring mainly for beginners or people looking to break into the market. I've got an entire curriculum built that I can help them with and provide guidance throughout the process. So a lot of people think it's very daunting, and it can be. Certainly, it's intimidating. There's no question. Yeah.
Yeah.
You know what it is? You got to learn the vocabulary. I tell people all the time, if you don't understand what people are saying to you, then you're never going to understand what the process is. Like if you can understand the vocabulary, you're already miles ahead, but it comes with like getting in there and like speaking it, or at least by osmosis, be around people who are speaking it, and you're gonna get it. You're gonna catch up to them. You're right. It's daunting, but it's only daunting because you don't understand what's going on yet.
And I already did that on this podcast. I said that I want 20% cash on cash, right? So that means what you put out in the deal, how much cash actually comes out of your personal bank account, and then what is your ROI in the first year. And so ROI is return on investment. So like if I put out, let's say $20,000 to purchase a property, 20,000 of cash, because I've done it different ways, right? If you're going into your rehabbing, you can start with hard money, and what they'll do is they'll lend on the after repaired value of the house. And so what that does is if you purchase it right, it allows you to work the numbers so that your actual cash out of pocket is much lower than a standard investment property, right? So let's say I put 20 out, I want $4,000 of return in the first year. That would meet the 20%, right? And so that's basically what I'm talking about on cash on the side of that side of things.
Whatever comes out of pocket, you're going to get something back. And hopefully your goal is to get 20% of whatever you put back. That means that the rest went into, it doesn't matter. It could have gone into rehab. It could have gone into loan costs. It could have gone into acquisition. But the point is, whatever you come out of pocket, the return has to be about 20%.
Yeah, and you want 20% of equity as well. So if that property that I put 20% out is, let's say, a $200,000 house, I would want to only owe 160 on that going in, based on the numbers, because I want that $40,000 of found equity in it.
And that's a good structure. That way you have some leeway when the market does shift, because it will shift. Not everything goes up forever, ladies and gents. What goes up will come down for a little while, but you have enough equity to survive that. On top of that, you've gotten a good chunk of your cash back. So over the next few years with the rental income profits, your cash flow on that should help recoup some of those funds. And then when you do sell later on, if you liquidate and sell, you get that 20% plus back. And if you bank on the appreciation and you do 1031, now you have a lot more equity to buy bigger and better things, right?
Yeah, you brought up a good point as far as leverage goes. Like how far do you want your portfolio leveraged? And we try to keep ours 65-35, somewhere around there, which so that we've got 35% equity in the whole portfolio or north of that. In each property, we do that individually as well to ensure. And the reason that is that the market swings and you've got to sell things off to keep other things alive. You can liquidate things quickly and not lose your ass, essentially. Is the idea. That in 2008, everybody had like 100% loans and had zero equity, or they were upside down, and you can't sell those things. So
if you're trying to walk away,
if you're trying to sell things real fast, and you got to come to the table with $50,000 from your bank account to get it done, there's not very many investors that are willing to do that very many times just to sell something, right?
Yeah. And that's why the banks ended up taking so many back. That's why people just walked away, because there was no point. They didn't have, I mean, you're right. It was a lot different lending criteria back then. I mean, I remember, that's how we bought our first house. Literally, we fogged a mirror pretty much. And here's a first and a second mortgage. And there you go. That's all you really need to buy this place. And they gave us the keys. We're like, what? Seriously? You're giving me keys?
Another fun fact is when you enter into a financial situation like that, which we experienced in 2007, 2008, if you have a ton of equity in your house and you're one of those people that are trying to pay your mortgage off, like those are the first houses they're going to foreclose on, because there's so much meat on the bone with those houses. If you own a $300,000 house and you only owe $50,000 on it still, the bank's going to take that way before they're going to take my house with $299,997 on the note, right? So I mean, I'm just throwing numbers out there, but like they actually do that as well, because that's a much better play for them, because then they can turn around and they've got an upside of $250K on the property they just took from Joe and Susie, who are trying to pay their house off. And if they sell it for 200 grand, they're making 150 out the door. And it's just way easier to get rid of those properties because they're not in the business of owning real estate.
No, they got to recapitalize. That's what they're all about. Jeff, man, some interesting stuff today, dude. I love talking, again, and nobody has a crystal ball. I have no idea what's going to happen in the future. Right. I mean, I'm just speculating here. I'm trying to look at things and again, hope for the best and plan for the worst, because change is upon us, man. Like nobody knows what's going to happen in the future. I mean, all kinds of crazy stuff, trade wars with China, and, we have COVID going on, the real estate market's super hot. I mean, you never know what the next trigger is going to be for things to shift. And it's always good to hear what other people are doing and how successful they're implementing their strategies, or what struggles they're having with, because that's the key, right? That's where we learn. Absolutely. And that's part of the reason that I like real estate as opposed to like investing in stocks, right? Because I mean, the stock market can swing overnight. You can wake up in the morning and you lost everything. However, a bunch, 40% of your money, right? Whereas real estate is slower train. It's like a train running down the tracks, and if you're paying attention, you've at least got some time to figure out what you're doing. Now, if you're overcapitalized or over leveraged, not overcapitalized, but if you're over leveraged, then you're going to have some tough decisions to make, right? But I think in the current economic climate, if you're pressure testing your systems you're saying, okay, let's increase our vacancy rate on our projections. Let's increase let's decrease our rent rolls by another 10% to hedge against all that. Can we still operate the portfolio? So increase your vacancy by 10 more percent, lower your rent roll by 10 more percent than your original usual projections, right?
because you're coming in with conservative estimates generally. Most people do.
Yeah.
And
now stress them out.
Right. And then if you pressure test them like that, and then you keep your capital in the bank to deal with that for a period of time, can you keep your properties for a year on those numbers? And then you should be fine, right? So like when I talk about a train, it takes the market, the real estate market's going to be like 4 to 12 months to adjust. So it's a much slower turn. They're not going to yank down your pants in 2 seconds and you're done. So you've got that period to adjust, as long as you're paying attention to what's going on and like staying involved to an extent.
100%. I mean, that's you're exactly right. You have time to make a choice, and there's no guarantee you're going to make the right choice, but you never know. The fact that you're pressure testing those things, I mean, and we didn't even have time to really dive into it, but the whole purpose of it oftentimes is to have that cash flow later on. It's so that you're not worried about, where your paycheck's going to come from, because you've invested enough to have that cash flow coming in, and knowing that a market is about to change, or knowing what your maxed level of vacancies can be, or whatever the situation is. You have that strategy put in place. You're being proactive in whatever it is that you're doing. You would do that anyways with a budget in your paycheck, right? You would do that anyways with pretty much anything that you're planning for. You should be doing that with your tax strategy. Right. And so there's no difference here. Once you know the numbers and you actually, have a forecast and you project, there shouldn't be very many surprises. Catastrophic events will happen every once in a while, but that's not the norm, right? That the norm is you can weather the storm for a year, you can weather the storm for 6 months, whatever it is. Things will adjust again, and then you'll be in a good position. So,
right. Absolutely.
Dude, Awesome having another chat with you, Jeff. Thanks for coming on a second time, brother.
Absolutely. Absolutely. Thank you guys for having me. It's always a pleasure to talk to you.
Always. All right, ladies and gents, that's all we got for you guys. Have a happy Monday. We'll talk to you again tomorrow. Peace.
Bye-bye.
And we're out.
Thank you for listening to the Business Bros Podcast. Are you looking to get more clients or to increase your income? Hernan, the business bro, can help you generate referrals through the power of podcasting. And James, the insurance bro with Pipeline Insurance, can help you effectively add insurance to your existing business. If you are ready to create wealth today and generational wealth for tomorrow, email businessbros@csfirst.com to schedule a free consultation, or join the Business Bros Network, www.businessbros.biz.